Hey guys, welcome back to another video. So in today's video, I wanted to talk a little bit about one of my favorite options trading strategies to use in the stock market, and that is the wheel strategy. So if you guys don't know what options trading is, it's essentially when you buy and sell options for any given stock or ETF. And I talked a little bit about this in my last video about how to buy and sell call and put options in the stock market. So if you guys missed that, definitely go check that out. A lot of the stuff from this video might be a little bit confusing for you if you don't fully understand how to buy and sell calls and puts in Robinhood. So just go check that video out and then come back to this one if in case you don't already have a basic underlying understanding of options trading. So if you want to try and trade options on Robinhood, basically what you have to do is go to any stock or ETF that Robinhood has. And some stocks aren't going to have options available, but most of them are. And so for this particular example, I'm going to be using the S&P 500 ETF, ticker symbol SPY, as an example. And so what you want to do is you just want to click on the stock, and then there's going to be a tab right here that says Trade SPY Options. You're going to click on that. And basically, just to recap here, this right here is the buy and sell options that are basically just going to let you know if you want to buy or sell any options contract. And then this is the call or put. This is going to determine what kind of option contract you're going to be buying or selling. So you can either buy or sell a call, or you can buy or sell a put. A call is basically an options contract where you're basically saying that you think that the share price of the stock or ETF that you're playing with here is going to increase in value. And then a put is the exact opposite of call. It's basically saying that you think that the share price is going to decline in value. And so we're going to pick a different expiration date here. Let's go with July 19th. And okay, so basically what the wheel strategy is essentially when you sell a put, you're going to receive the premium that's on the right side here for whatever options contract it is that you try to sell. So let's say I sold this options contract at a $434 strike price with a $1.46 premium. And so when you're dealing with options contracts, you're always going to be dealing with 100 shares of the company. So whatever this value is, you have to multiply it by 100, and that's the premium that you're going to be receiving when you try to sell this put. And so since this is $1.46, if you sold this options contract, you would receive $146. And excuse me. Um, Similarly, on the left side, you have the strike price for the options contract, which is $434. And since you're dealing with 100 shares, you're going to have to multiply this value by 100 as well. And what this number is basically telling you is this is the amount of money that you are going to need as collateral in order to sell this options contract, or this one, right? So since this says $434 and we're dealing with 100 shares, you are going to need to have enough collateral in your account in order to sell this particular options contract for SPY. So since the share price of SPY right now is $434.06, in order to sell this put contract, you would need $43,400. And a lot of people might not have that. So if you do want to implement the wheel strategy, you can pretty much do it on any other stock that might have a smaller share price. For example, not AMC, AMD. And you can see AMD right now only has a $86.98 share price, and you could essentially do the exact same thing with AMD. It would just be cheaper. You wouldn't need as much collateral in your account to do it, and also you would still receive the premium here. So let's use AMD as an example for this one. So basically how it would work is you would sell this put contract, right? You would sell this put contract, and when you sold this put contract, it would lock in your 86,000, I mean not your 86, $8,650 as collateral, and you would receive $158 as premium. And once this happened, you essentially be holding on to this contract, and if the share price of AMD dropped below the strike price of your options contract, of your put contract, you would be assigned 100 shares of AMD at the strike price on your contract. So right here, the strike price would be 8,650. So that would be the price of your of your shares, of the 100 shares that you were assigned. It would be $86.50. And then once you had those 100 shares of AMD, you would immediately start selling calls, because in order to sell calls, you need 100 shares of a company. And so the way the wheel strategy essentially works is you don't have any shares of this company yet, but you do have enough collateral in your account in order to buy 100 shares of this company. And so essentially what you would do is, instead of just buying 100 shares of the company without getting paid to do it, you could sell a put for AMD, and you would essentially get paid to buy 100 shares of AMD. So you would get paid the $158. And then if the share price doesn't drop below the strike price, then you won't be assigned any shares, and you can just, the next week, you could do the exact same thing and, just sell another put contract and sell another put contract and another put contract until the share price of AMD dropped below the strike price of your contract. And once that happened, you would be assigned 100 shares. And once you have 100 shares of AMD, then you can immediately start selling calls in the opposite direction. And so once you have 100 shares, let's say you have 100 shares at the current share price, which is $86.95, you could sell a call at, let's say, $90, right? $90 per share. And you would get paid $2.06 per share for this options contract. And since you're dealing with 100 shares, you would get paid $206 for the contract expiring on July 3rd. And essentially what this means is, if the share price of AMD rises above the strike price of the call option that you sold, you would be forced to sell your shares back to the market at the strike price that you designated when you sold the call option. And how this works is, it's basically a win for you, and it's a win for the person who you sold the call option to, because for the person who you sold the call option to, they essentially bought the call option, and they essentially bought the right to buy AMD at $90 per share and then sell it immediately at whatever the current share price is. Ideally, it would be higher than the strike price of the options contract, because that's how they would make money. They would buy it low and then they would sell it high. But for you, you would also make money because you already have 100 shares of AMD, and let's say you had it at, $86.95. If the share price rises above $90, not only do you get to keep the premium that you received for selling this options contract, but also you get to keep all of the gains that you made from the increasing share price of $86.95 to $90. And obviously, if it rose to like $94 or $93, you wouldn't be able to keep that extra gain, because you would be forced to sell it at $90 to the person who is buying it from you at $90 and then immediately selling it at 94 or 93. But it's still worth your investment, because in the event that the share price doesn't rise above 90, you would basically just get paid extra premium to hold on to AMD. So it's basically free money. And then obviously, if that were the case and the share price of AMD didn't rise above the strike price of, whatever the options contract is that you were trying to sell, then the very next week you could just continue to sell calls on the 100 shares of AMD that you're holding, and then just, every single week just continue to sell calls and make more money on the premiums that you're collecting. And then once, eventually the share price inevitably rises above the strike price of the options, of the call option that you sold, you would immediately just go back to selling puts on AMD and then repeat the process all over again and just collect premium, get paid to buy 100 shares of the stock, and then also get paid to hold on to the stock. And that's essentially how the wheel strategy works. It's one of the best, I think, options trading strategies that you can implement in the stock market. And it's one of the ways that you could just, along with holding on to the to the stock, the 100 shares of the stock, and making the money just from the gains that the stock makes, you'd also be making extra money from pulling in the premiums for selling put options and selling call options. So that's pretty much it. If you found any value out of this video, make sure to leave a like, comment down below on what you guys are investing in, other options trading strategies that you guys are trying to implement or that you guys want to learn about. I'm definitely going to be talking about more in future videos. And if you like what you're seeing on the channel, then make sure to subscribe to never miss another video. And that's essentially it. Thanks for watching, guys. See you in the next one.